Budget. A budget is an estimation of revenue and expense over a specified future period of time. A budget is the financial statement of the estimated revenues and expenditure of the government in the coming financial year. It is the most important information document of the government. A budget has two parts. The first part is something like an annual report. It gives an overall picture of the financial performance of the government during the period since its last budget. The second part presents the government's financial plans for the period up to its next budget in order to inform the country and get legislative approval. In modern times, budgetary policies plays an important role in the economic stabilization of a country. Components of the budget. The budget of the government is split into two: revenue budget and capital budget. Revenue budget includes the revenue received of the government and the expenditure made from such revenues. And capital budget includes capital receipt and capital expenditure. Revenue receipts and revenue expenditure. Revenue receipts include tax revenue and non-tax revenue. The tax revenue include revenue from direct tax like income tax, interest tax, wealth tax, corporation tax, etc. And also the revenue from indirect taxes like sales tax, excise duties, customs duties, etc. The non-tax revenues of the government include commercial revenues of the government, railways, post office, toll, interest on funds borrowed from the government, electricity, certain industries, etc. Investment revenues of the government, interest and dividend. And administrative revenues, fees, fines, penalties, cheats, etc. The other sources of revenue of the government are income from public properties, gifts by the people, grants by other governments, etc. Revenue expenditure is the normal running of the government departments, provision of various services, interest charges on debt incurred by the governments, subsidies, grants in aid to the states, etc. The speciality of revenue expenditure is that it does not result in the formation of assets. Capital receipts and capital expenditure. The capital receipts include market loans, borrowings from the RBI, loans from international agencies, recoveries of loans granted to states and union territories, etc. Capital expenditure include expenditure for the acquisition of assets like land and building, machinery, equipments, etc. Types of budget. First one, balanced budgets. Second one, surplus budget. Third one, deficit budget. Balanced budget. A balanced budget is one where estimated expenditure is equal to estimated revenue. For the purpose, let us assume that the only source of revenue of the government is a lump sum tax. In balanced budget, the tax is equal to the expenditure. Let us introduce a concept known as marginal propensity to consume, MPC. MPC is the ratio of the change in consumption to the change in income. It is calculated as the change in consumption divided by the change in income. It may expressed as delta C by delta Y, where delta C is change in consumption and delta Y is change in income. Assume that MPC of the community is equal to 3 by 4. The change in consumption is 3 by 4 of the change in income. The decrease in consumption or aggregate demand due to the tax is equal to MPC into tax. On the other hand, The increase in aggregate demand due to government expenditure is equal to the amount of the expenditure. Then the increase in aggregate demand due to the expenditure is greater than the decrease in aggregate demand due to the tax. The net result is an increase in aggregate demand by an amount equal to the expenditure times income minus MPC. Thus, a balanced budget can bring the economy, which is at near full employment, to a state of full employment. For example, let us assume that the tax amount is rupees 1000 crore and the expenditure of the government is rupees 1000 crores. It is equal, and the MPC is 3 by 4. Then the decrease in aggregate demand equal to rupees 1000 crores into 3 by 4 equal to 750 crores. The increase in aggregate demand equal to rupees 1000 crores. The net increase in aggregate demand equal to rupees 1000 crores minus rupees 750 crores equal to rupees 250 crores. Surplus budget. In the case of surplus budget, the estimated revenues are greater than the estimated expenditure. The lump sum tax by the government lowers the consumption of the people and thereby the aggregate demand by an amount equal to MPC into tax. At the same time, government expenditure increases the aggregate demand by the amount of the expenditure. If the tax amount is sufficiently higher than the government expenditure, the reduction is aggregate demand MPC into tax may become greater than the increase in aggregate demand due to the expenditure. The result is a net decrease in aggregate demand. This falls in aggregate demand can combat inflation. But a surplus budget is never recommended in the case of deflation and recession, as it worsens the situation. Let us assume that the lump sum tax amount is rupees 1,500 crores. Expenditure amount rupees 1,000 crores. The MPC equal to 3 by 4. Then the decrease in aggregate demand due to tax equal to 1,500 crores into 3 by 4 equal to 1,125 crores. The increase in aggregate demand due to expenditure equal to rupees 1,000 crores. The net decrease in aggregate demand equal to rupees 1,125 crores minus rupees 1,000 crores equal to rupees 125 crores. Deficit budget. A deficit budget is one where the estimated revenue is less than the estimated expenditure. It means that the expenditure exceeds the tax. The decrease in aggregate demand due to the tax is equal to the MPC into tax. The increase in aggregate demand due to government expenditure is equal to expenditure amount. If the tax is sufficiently less than the expenditure, the decrease in aggregate demand will be less than the increase in aggregate demand. The net result is an increase in aggregate demand, which will combat recession. Thus, a policy of deficit budget is recommended during the times of recession and unemployment. Let us suppose that the tax is rupees 1,000 crores and the expenditure is rupees 1,500 crores and the MPC is 3 by 4. Then the decrease in aggregate demand equal to 3 by 4 into 1,000 crores equal to rupees 750 crores. The increase in aggregate demand rupees 1,500 crores. The net increase in aggregate demand equal to 1,500 crores less 750 crores equal to 750 crores. Fiscal deficit. Fiscal deficit is the difference between total expenditure and total receipt. Total expenditure include revenue expenditure, capital expenditure and loans net of repayment. The amount of fiscal deficit indicates the amount of borrowings required by the government. Large borrowings create the problem of heavy interest payment in future. Large fiscal deficit may also fuel inflation. Revenue deficit. Revenue deficit is the excess of government's revenue expenditure over the revenue received. It is considered as a good reflection of the government's extravagance and wrong fiscal policy. A deficit on revenue account basically implies that the government is borrowing to maintain even its consumption expenditure. In India, the revenue deficit was continuously rising during the past decades. In 1991, it was 3.3% on the GDP. It rose to 3.6 of the GDP in 2001.